Hi, I'm Bill Baruch, president of Blue Line Capital, and this is the Triple Play podcast. I'm here with our analyst, Jannis Meindl. We're looking forward to bringing you this macro in three stocks. It's pretty exciting stuff here. Big week, Fed, a lot of earnings. Let's hop right into it. Jannis, take us with the macro.
Yes, thanks, Bill, for the intro. So let's just look back on last week's GDP report. We saw a number 2.9% annualized during Q4. It was certainly not a recessionary type number that a lot of people might have been hoping for earlier in 2020. One of the key things within the report was that inventories did contribute about 1.5% to GDP growth. So maybe as that one comes in, but that did also detract from growth when we were in those recessionary conditions sort of earlier in 2022. One subcomponent that I found quite interesting was that private investment did bounce back quite sharply from negative 9.5 to positive 1.22. But the 4-quarter average of that private investment is still at negative 4.4. And then specifically within the private investment, you have private fixed asset investment, which is a proxy for companies and how much they're spending on property, plant, and equipment. So think of any sort of chip company that builds a plant, and that number ticked down to negative 6.7. So that just tells you that companies are maybe a little bit more cost conscious than they were before, and so that's definitely going to flow into the economy. But the question is whether we are at trough levels. I think another data point that we got was PCE, and I found that one quite interesting, especially as inflation is slowly but surely converging with income trends. So what does that mean? PCE came out at 0.1 and income trends came out at 0.2 on a month-to-month basis. So as we get some positive real wage growth, people are going to keep spending, and maybe as wage pressures come in a little bit. I know you, Bill, will cover the employment cost index from today, but as income goes up, as wage negotiations continue to go on and people demand more from their employers, and inflation comes in, that's sort of a Goldilocks scenario for economic growth. But maybe, Bill, you take it away with some of today's economic data and what we got.
Yeah. Talking about Goldilocks, I think that employment cost index was, the market certainly received it, Goldilocks, and financial Twitter was really lighting up on it. It was 1%. This is a quarter-over-quarter number, 1% increase, and then it was 1.3 for the prior quarter. So this is down. They're looking for 1.1. So it's below expectations. As these wages continue to slow, it's expected or thought to be taking a little bit of tailwind away from inflation, and people aren't going to be spending as much. But the reality is, wages. This employment cost index is still at extremely high levels, just coming in a little bit. But if you look back over the last 2 decades, it's rarely been at this level. Just a few idiosyncratic times that it was. So I think when you combine the fact that it's still very elevated with a lot of froth really building back into the markets. We noted last week the 0 DTE options, but really one of the things though to lean on is the consumer. We continue to believe the consumer is strong for many reasons, but may not be the lower end consumer, but the high end consumer is very strong, and I think that's really carrying the economy. And those that can't afford it don't have an issue using credit. So for at least right now, we're seeing a lot of money being pumped into the economy, and that continues. This brings us into the Fed meeting, and I think we'll get Jackson Hole Powell tomorrow more than really hearing the sort of Christmas Powell. Now, the markets did sell off in December after he spoke, but I think overall, we've seen the committee members sort of pave the way for the slowing pace of rate hikes. But as this froth is built up, I think they want to get in front of it. The other question is, is housing picking back up? Today's Case-Shiller data showed housing prices fell a little less than expected. And then, that now we move into the non-farm payroll. We also have ISM tomorrow, ISM manufacturing. But on Friday, ISM non-manufacturing along with the payroll data. So a lot of data to digest. And, maybe we'll walk away this week with some answers coupled with all those earnings, and we'll see where we are. But a real big week ahead. But let's jump in. We got some great names here to cover today, starting off with ServiceNow. And this is an interesting stock, interesting company. Bill McDermott, he's well known within the industry, running ServiceNow, the CEO, and I think maybe a lot of the multiple. It's a very high multiple name. It's still forward earnings, forward PE of 50. Trailing is I think, what is it, 280? 280 trailing PE. So it's a high multiple name. But people continue to pay for it. It came down a bit last year with as long as with everything, but it's been sort of levitating out in front of. It may not be the 50-60% gainers, some of these high beta names, but it's levitating above its peers right now. And I think you're bringing in. If you're buying this company, if you're buying the stock, and you're investing in this company, you're paying the multiple for Bill McDermott. You're paying the multiple for these large contracts they have. We honest, you and I were talking about this. Is $1 million or more cash payments per quarter clients has increased to 1,637, and that right there covers. They pull down 1.9 billion per quarter. So you're looking about 85% of the revenues come from these large clients, and the retention rate's 98%. So you're paying a high multiple, but you know what you're getting with that. So I think that is an advantage. We've owned this name on and off. It's for us. We like it. There's times to own it, and right now I'll get to the chart. But after Jannis, why don't you step in here and let me know? So give us some of the data.
Yes. So in terms of the business overview of ServiceNow, it's really in the enterprise resource planning space. So what does that mean? And this is from the Oracle Investor Relations site. So this is not ServiceNow, but just giving you an idea. So that just means that how does a company organize its data? And in corporate America, we really have a theme where the entire economy is still running on ancient software. We didn't only see this with the FAA problems that were recent. We also saw it with Southwest Airlines. All these companies have old software in place from tuck-in acquisitions, from various Excel spreadsheets that different departments are running on. So the IT person might be running their own spreadsheet. If they need to solve a problem with the server, then the person responsible for actually fixing it is running a different spreadsheet. And ServiceNow is really about that workflow integration, that all these processes are running a lot more seamlessly. And as a result, the company has seen a lot of growth. I mean, this is a dominant play in the space. Since 2019, the company saw in the high 20s revenue and gross profit growth. And then also speaking to the industry trends, the industry is expected to keep growing with the leading companies like ServiceNow out ahead and in charge of this industry, really. And if you look at how their costs are really comprised, you see that a lot is going towards selling, marketing, but also research and development expenses. So maybe as gross profit margins, which are in the high 70s, if they can pull back on some of that spending and selling and marketing, and maybe also R&D, the multiple will come down substantially. So while the multiple of 50 does seem indeed high, it is not as bad if you think about the cost cuts that they could do in case they are less focused on growth and maybe more focused on cash flow. So this business definitely has optionality in that regard. And Bill, I'll let you cover some of the chart dynamics and how you think about portfolio allocation here.
Yeah, there's a lot of really great slides, really on every triple play podcast we do. So don't hesitate to ever pull up the chart books when you're watching this podcast and go through some of this stuff. There's a lot of great information to dive. We can't cover it all here for you, but all right. So this chart, we got a breakout of ServiceNow, and that's why it's on our radar to buy back in right now. We just think the market itself has built a little bit of froth, maybe got out ahead of itself in this January, especially ahead of the Fed. Like I said, we'll get some answers this week. We'll see where we are. But right now, as this stock has broken out, it is also facing resistance. So you got the 382 retracement on this whole range back to its record high. We'll see how this is received in the coming days. But I think a back test of that trend line would potentially bring a good buying opportunity. Moving on, the next one is one that we haven't owned, but it's certainly on our radar, is Deckers. Deckers is a story right now where you got a brand that has just been a massive tailwind to the public. Hoka shoes, and then Hoka shoes, and then UGG brand as well as they own. And I own the shoes. My family, I got three girls and my wife. There's some Uggs between them, let's say. So I think that's common across many households. And it's a household name, household brand, but not many know Deckers is the parent company here. tremendous amount of growth in recent, over the last year. It's gotten maybe a little ahead of itself, and I'll show you the chart in a minute. But as one thing to kind of really look at here is you got the compound annual growth. So revenues with wholesale growth of 14.1%, compounded, in direct-to-consumer sales growth by 19.3% compounded since 2019. So you got these numbers that's really been built up, but it's been really over the last year that it's been running quite a bit. So, Jannis, why don't you hop in here and give us some of the data?
Yeah, I mean, you spoke to the direct-to-consumer sales that have really gone up, not only across the company, but specifically looking at Hoka and the dominating brands. I mean, they have been on a real run, and the pairs sold since 2019 have also compounded at an annual rate of around 12% since 2019. So a lot of tailwinds. To me, this is really more a consumer discretionary story and how much consumers can keep spending. I mean, in the past, we've talked about excess savings, how much deposits there are in people's bank accounts. On the left-hand side of this slide, you can see how much deposits there are. On the right side of this graph, you can see the extent to which revolving credit plans, so meaning credit cards and such, to what extent consumers have taken on that part of the debt structure. Year to date, that revolving credit is up by 17%. At the same time, that the credit card rates have also gone up towards 19%. So consumers are spending, and they are taking on those credit card plans. Quite surprisingly, though, even though they keep spending, they keep pouring money into the economy, delinquency rates, so the default rates of consumers, have remained extremely low, below pre-pandemic levels. We saw Visa come out strong. We saw MasterCard strong. Discover Financial note that in 2020 they had 20% loan volume growth on the credit card side. They expect low double-digit growth rates in 2023. So you see that a lot of these companies are still eager to lend money to the consumer as they're not defaulting on these loans. We shall see whether the spending can keep up. We have definitely seen some pandemic impact there with a lot of these transfer payments. But as of right now, things do remain healthy. The economy is definitely on a run still. And I'll hand it back to you, Bill, in terms of portfolio allocation again.
Yeah, like I said, it's a stock that we don't own at the moment, but this is a consumer discretionary name. So if you're buying this name, you're buying it after a run. Look at here in the chart; it's moved into resistance. It ultimately, we want to see a pullback. We've been watching it since November, and it just kind of kept going. If as a consumer discretionary stock, we've been talking about a strong consumer. We think January retail sales data is going to be a blowout number. Comes out in a couple of weeks, but again. How much of this is priced in now? So that's the way you got to look at it. Is it the market's discounted quite a bit, and there needs to be maybe some froth built out of it, taken out of it, and that's where we kind of look at $400 on the name. It'd be about a 5% pullback, maybe a little more than that. If it can hold there and start building a base, that would be the spot that we would see this market, maybe a good buying opportunity to build for the potential breakout. It's tough to buy this name into this resistance, at least now, given the overall macro narrative. We're overall light on consumer discretionary. We own Amazon. You're gonna get some of that exposure in Amazon, obviously the tech company. But as we transition here to our last name, Deckers is a higher end consumer discretionary. Now, the other name here we're moved to is McDonald's, and McDonald's is really servicing that lower end consumer in those who are trading down to spend less money, and has benefited from that. They reported earnings today, beat top and bottom line estimates. However, the stock traded down as much as almost 3%. And then it came back. I think it finished down the day about 1%. What they're talking about too is CapEx. That may have been a reason that the stock traded lower. They're going to start spending more money. I think it was between $2 billion and $2.5 billion. They plan on spending in CapEx in 2023, but half of that's going to go towards more restaurants. So they're investing in more restaurants, means more revenue down the road. At that point, it's a good longer term story. The question though remains, what is this? How much is built into this price? So I'll get to the chart here in a moment. But one of the things that they also remember too, it is a higher multiple name right now, 26 times earnings. It's in line with its peers. The question would be, is it going to pay a little bit less for it potentially? That's kind of what we're waiting for. Though I see us moving into this name sooner than later, maybe even by the end of the week.
Yeah, thanks, Bill. In terms of covering McDonald's, the main shift that we've seen with this company has really been from a lot of company-operated restaurants to moving to the franchise models. And what it has that meant, less than 5% of all McDonald's restaurants globally, and they have more than 40,000 of them, are operated by the company directly. The rest are franchisees, meaning other operators who just use the McDonald's brand, the McDonald's product to operate those restaurants. And McDonald's is profiting from those restaurants in terms of collecting rent, because McDonald's might provide the property, they might lease the property, and then sort of be the broker in between the McDonald's, the property, and the franchisee. And they're also collecting the royalty on the revenues that those franchisees earn. And as a result, operating margins have gone up substantially since 2017. 2007, that is, from 35% to 55 in 2021, and that just keeps accelerating to the upside as the company keeps being more focused on the franchise model. And you can see on the left side there that operating income from company operated restaurants has actually gone down. On the next slide, you'll see where the income from the franchisees is really coming from. And growth trends continue to be relatively strong. The company added more than 500 restaurants in China in 2022 alone. They added about 240 restaurants globally, even though they had to close down 800 restaurants in Russia. So they continue on this growth path. They know that strong trends in the chicken segment. They know that strong trends in their core products. So a lot of the underlying trends continue to stay strong. In terms of the next catalyst, now that they have undergone this transition to a franchise-based model, which means higher margins and such, the catalyst question might not be as clear as more than 95% of all restaurants are franchise-owned. So in terms of catalyst, it's a little bit more difficult than maybe it was a couple of years ago, but it keeps being a cash flowing machine pretty much, especially with those franchisees bringing in a lot of the operating income as we stand.
Yeah, it's a great point. I mean, the franchise model is terrific. I mean, I think that's really what's powered it, and will continue to power it over the last year. This chart, I think it's constructive. That's why that we're looking to get into this name. We have some cash to put to work. We may rotate out of something like a Dollar General and buy this name. So that will remain to be seen here before, by the end of the week. But that's kind of what's on our radar. You can see this consolidation at these previous highs. A lot of volatility through March. It had a little bit more volatility relative to some of its peers in March. They had a number of restaurants. Jannis, how many restaurants do they have in Russia that they had to shut down?
They closed on 800.
800, yeah, 800 restaurants in Russia. So there's a lot of volatility through there. It's come out of it really nice, though, and it's building a very constructive. This is a weekly chart, sort of like a bull flag, almost like pattern here at its highs. I think it could be ready to make its next move here if the market questions around the consumer are answered. So it's definitely a solid name, and will continue to be. We do like it quite a bit. Jannis, anything to add before we close it out?
I think that pretty much sums it up. I mean, it's a stable play, and it continues to shift towards the franchise model. I mean, I would just say one thing. We have more than 40 slides here this week, so check that chart book out on your own time. There's a lot of material there.
Yeah. That chart book, it's definitely, there's a lot there, a lot to unpack in there. And feel free to ping us with questions. We're always eager to answer questions and connect with you. So that's it for today's Triple Play podcast. I'm Bill Baruch, and I'm here with our analyst, Jannis Meindl, and feel free to reach out. Thanks a lot. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.